Is the market going to sustain this rally, this insane rally that we saw yesterday, February 24th? The NASDAQ was down over 3% to rally almost 7% from the low point to end the day up over 3%. That is one of the wildest swings in stock market history. However, looking back in hindsight, we're going to go over why that happened and why this rally may not be sustainable. This may have trapped a lot of people into FOMOing, and why I think the market can continue to tank until the next CPI reading on March 10th and what you should do about it. I'm going to leave everything below in the chapter so you can forward and rewind as you like. As always, I intend to make these videos as helpful as possible to you. If you get anything out of this video, leave it a big fat thumbs up and let's get right into it. All right, so first, why did the market tank like this and how did it make this amazing intraday recovery? Well, it tanked overnight because Russia had invaded parts of Ukraine, or at least there were reports that Russia invaded parts of Ukraine and started bombing and artillery campaigns. The price of oil futures went to $100 a barrel naturally, and the stock futures started tanking. As we've stated before on this channel, an invasion of Ukraine does not directly affect the United States, and a conflict with Russia doesn't directly affect the United States from an economic perspective because Russia ranks dead last in the top 30 in terms of trading partners with the US. But look who ranks number one is the European Union. And if this affects the European Union, then it will undoubtedly affect the United States and the global economy. So that naturally sent the markets in a panic, and we saw the NASDAQ down by over 3%. So why did it recover intraday so violently? There are a few reasons for this. Number one, short covering. As I told you on the previous video before I did the live, I said that we are seeing a record number of puts here in the options market. There's a record number of shorts. And because these stock futures were red and everyone expected the market to keep going down, traders kept on buying these long put options at market open. Now, alongside, side by side, what was going on is that bond buyers were buying treasuries heavy. They were buying treasuries heavy as a safe haven because remember, bonds are fixed asset products, meaning that they give you the same return regardless of what happens. So if you buy a 10-year bond that has a 2% coupon, then you're getting that 2% regardless of what the market does, regardless of what goes on in the geopolitical climate. That is why bond buyers flock to bonds during times of uncertainty. Now, remember, there's an inverse relationship between bond prices and bond yields. So as more people, imagine that this is a bond buyer, as more people start pouring into bonds, right? The demand for bonds goes up and the price of bonds goes up. What happens when the price of bonds go up? Well, the yields of the bond go down, right? And what happens when bond yields go down? Growth stocks tend to do really well. Now, in addition to that, yet another reason why the market kept rallying, this also has to do with interest rates, but not bond yields specifically, but the federal funds rate, the federal interest rate, right? The thing that we talk about when we say that the Fed is going to raise rates or decrease rates, right? This 50 to 75 basis point probability, meaning that the probability that the Fed will raise the rates by 50 to 75 basis points or 0.5% to 0.75%, by March 16th, this was 60-something% just a couple of weeks ago. It is now less than 10%. Why is that? Well, because of the prospect of war. If there is a potential for a recession globally, if the economy looks like it's going to slow down due to conflict, geopolitical conflict, right? The Fed is much, much less likely to be aggressive with rate hikes. And so the Fed members are now pricing in a possibility that the Fed is going to raise rates aggressively at less than 10%. And we are seeing almost 91% at the 25 to 50 basis point hike, which is considered pretty, minor, pretty dovish. However, guess who likes low rates, both low federal funds rates and low bond yields? The stock market. You guessed it. So all of that combined, what happened to those puts that were bought at the open, those, the record number of puts that were bought at the open, well, the market started going up due to some of the factors that I just talked about, specifically with regards to yields and rates. And as the market starts going up, everyone realizes, holy shit, this day is going to turn green. Oh my God, this day is going to turn green. So what happens is short covering, meaning those people who are long puts now have to sell those puts back to the market makers. And the market makers who hedged their positions with short stock, meaning when they sold those puts to those people who wanted to short the market at the open, market makers hedge those positions by shorting stock, taking the opposite position. If you don't get that right away, it doesn't matter. I'm not going to not trying to confuse you. But in addition to that, market makers now have to buy stock in order to close that short position. So not only are puts being closed, but stock is being bought. And that fuels, it's almost like a gamma squeeze on the call side, like we saw with GME and AMC. But this is on the put side. So we see this massive green candle today. This is one of the largest flip-flop days in history. I took a look at this. Actually, I will leave this link in the description because it's super interesting. The largest daily changes in the NASDAQ composite. Fun fact, the second highest also happened this year on January 24th. Now, in terms of total percentage, right? Like I said, the NASDAQ ended up 3.5% higher on the day, but it was really the swing that was astronomical, down 3.5% and then rallied to be up by 3.5%. However, we've seen, for those of us that lived through the dot-com bubble, and through 2008, those were the wildest times. Like there was a time that we saw the NASDAQ increase by 14% in one day. I've never seen that ever since. Now, the question on everybody's mind, is this sustainable? Does this mean that we have found the bottom? In my view, no. When we see these types of gamma squeezes, right? Put covering generally is considered a much less stable rally in a very, to use the Fed's term, transitory rally. It is very temporary because it is sort of a synthetic or artificial reason why the market is going up and not a fundamental reason why the market is going up. We still have this backdrop of inflation here that remains unsolved and will remain unsolved until the CPI data comes out March 10th, which you should definitely put on your calendar and keep an eye out for. Has anything fundamentally changed with inflation? No, absolutely not. As a matter of fact, if you look at the inflation chart, it is actually quite scary how high up we are and how fast we are rising, right? Like just back in January 2021, inflation was 1.4%. Naturally, we were coming off of a recession, a very short recession during the Rona crash of 2020. But we went from 1.4% January 2021 to 7.5% January 2022. That is just insane. And if you look at those wild swings in history, those have actually caused recessions. This is the highest inflation in 40 years. So there is no way to predict whether inflation is going to go down or not, especially because the next CPI print we get will be on February's data, right? Remember, it's a lagging indicator. And if you look at what's going on with oil futures, we hit $100 basically today. So how can February inflation numbers be favorable or come under expectations when oil has been rising all throughout February, right? Now, I hope to be wrong. I hope that oil isn't really the only indicator of inflation, but if oil has been steadily rising throughout all of February, I can't imagine that inflation numbers will come under than expected. So in my view, the fact that the rally was artificially created or contrived, right, synthetically contrived by short covering, and the fact that we still have this backdrop of inflation, I unfortunately do not think that this is a sustained rally. Now, it does not mean that we are going to crash into oblivion, right? I do think that there is a case to be made for a more volatile environment as opposed to just a straight shot down. However, this head and shoulders pattern here that you see at the top, this is not a good look. This is a very bearish pattern, and we have already broken below it. Now, if March 10th comes out and somehow by some miracle, the inflation reading is better than expected, then I think at that point we will have likely seen the bottom for 2022. Very hard to tell now, and I would bet that we see a little bit more downside. But now this brings us to the question of what to do. What do you do now as an investor, as a trader? Well, if you are a trader, you're lucky because you likely know how to play all sides of the market. As you guys know, we've been hedging our positions constantly for months now, right? And we continue to open up new hedges. And fun fact, we opened up a new hedge today. I wanted to take advantage of this monster move on the NASDAQ and say, hey, the next time that the NASDAQ goes up, I actually want to hold another short position as a hedge on NASDAQ because I hold a lot of NASDAQ stocks in my long-term portfolio. So we opened up another 345, 350 short call spread expiring March 11th on the NASDAQ. By the way, if you guys want access to all of this stuff, link is in the description below. The options trade bot went absolutely bananas today. This Facebook call right here that our options trade bot called out, this went up 800% intraday on that bounce up. And it had an above 86% confidence level that this trade would work out. So congrats to those who took this trade. Again, if you want access to all this stuff, link is in the description below. But other than holding hedges, what can you do now? Well, I also said that these are the levels at which I want to start nibbling. I want to start dollar cost averaging. I still think that in this environment, cash is also a hedge. However, if we look at the weekly chart on the NASDAQ, let me just remove this out of the way. You'll see that we hit the 100-day weekly on the NASDAQ, which traditionally is always a buy point. If you bought the NASDAQ every single time in history that it has hit the 100-day moving average on the weekly, in the long term, your portfolio would be golden. So we nibbled a little bit on the NASDAQ. Now, one thing that I did also nibble on is the SPY-V. The SPY-V is the value sector of the S&P 500, not the growth sector. Because we are entering into this high inflation, potentially high interest rate environment, value stocks are outpacing growth stocks by a lot, and they haven't dropped. If you look at the SPY-V, you'll see that it looks still very solid compared to the regular S&P or the NASDAQ because value stocks have actually been killing it. And I want to invest in value blue chip companies that have a high dividend yield that will likely be able to curb some of that inflation. So right now I'm looking at McDonald's. Coca-Cola took a nice haircut today, gap down to the 50-day moving average, another one that pays a nice dividend and is also a value blue chip. Disney, which I liked before earnings, is back around that level as well. Intel, in my view, is at a buy point, at a historic buy point. You could see here that every time it hits this level, going all the way back 3 years now, Intel has been a buy point here. And then XLP, which is the consumer staples sector of the S&P 500, because consumer staples do really well in high inflationary, high interest rate environments. It doesn't mean it's going to skyrocket, but it declines at a much less rapid pace than growth stocks. And XLP also pays a nice dividend as well. Anyway, traders, that is it for this video. If you want access to all of our trades, all of our long-term trades, options, hedges, futures, etc., link is in the description below. We have a complete beginner section where we have a former financial analyst, Coach K, who is answering beginners' questions all day, every day. We're going to be holding live coaching sessions with her. She's going to be teaching beginners how to evaluate companies, how to do fundamental analysis, technical analysis, etc. So come be a part of the community. It's a great value. Link is in the description below. Hopefully, you got some clarity on why the stock market on February 24th had one of the wildest swings in history and why I think we should be cautious here. And again, for those long-term stocks that I talked about, I'm not saying that I'm going to be blowing my whole portfolio here. This is just a nibbling opportunity because, you know, when I look at stocks like Apple that are 15% down or the NASDAQ that is 20% down, to me, those are too good to pass up, regardless of whether that is the bottom or not. But it doesn't mean that you have to go ham at these levels because due to what I talked about in the video, I think that we have a little bit more downside to go and a lot of uncertainty on the inflation front, which is still the number one enemy of the markets at the moment. Prayers up for all of those who are in Ukraine. Any of you guys who know anybody in Ukraine as well, leave a comment down below. Let me know what you think. Hit that thumbs up, subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.